Negative oil prices. Is the entire system starting to collapse? I'm going to explain that to you in 3 simple, fast steps. Step number 1, we're going to figure out how on earth this actually happened. How could we have negative $40 a barrel oil? It doesn't make sense at all, but it starts with understanding the fundamentals from the cerveza sickness. Of course, we are all in lockdown mode, so we drive less, we fly less, there is less stuff being manufactured and less things being constructed. Therefore, we aren't using the same amount of energy. Our energy needs drastically shrink. That means we're using a fraction of the amount of oil the economy typically uses. So OPEC Plus comes to a meeting because they are going to reduce the supply of oil to prop up the price. But in this meeting, MBS himself, the crown prince of Saudi Arabia, Mohammed bin Salman, gets pissed at Putin, or Putin gets pissed at him. Who knows? The end result of the meeting is they both give each other the bird and they say, you know what? Screw you. If you don't want to agree to play ball, we're going to increase the supply of oil. We're not going to cut back. So we're going to purposely crash the price of oil just so you will learn your lesson. The net result from these fundamental drivers is oil starts in the mid-40s, crashes all the way down to $20 a barrel. Now let's look at the technical side of what's going on that's adding downward pressure to oil, so much so it's taken prices negative. Of course, it all starts with the Fed. Back in 2008-9, they go to ZIRP, 0% interest rate policy. This is more central planning that I always talk about. They artificially lower interest rates. Interest rates are the price of money. Money is 1/2 of every single transaction. So the Fed manipulates the price signal throughout the entire economy. This creates a misallocation of resources. Specifically, the banks have to go further and further out the risk curve to get a return on their investment. So they start making more risky investments. Well, insert the shale producers. Very risky. A lot of them produce the oil at a loss, but they all get as much money as they need because of the Fed. This takes us straight over to Shale Sean, who's got himself this awesome looking oil well up in North Dakota. But he is very concerned with what's going on with the price because it costs him $70 or $75 a barrel just to get the oil out of the ground. And oh my gosh, now prices are at $20 a barrel. What am I going to do? But we have to remember that an oil well doesn't have an on and off switch. It takes a long time to wind down a well to where it's not producing oil anymore. And Sean has employees he needs to pay. There's bank loans that he needs to service. So he doesn't have a choice. He's got to keep pumping oil regardless of where the price goes. So now we insert Cushing Corey. He's getting a little frustrated with Shale Sean because Sean keeps pumping oil nonstop, even though there's not much storage left in Cushing, Oklahoma. This is where all the oil in the United States ends up for delivery. So Sean keeps pumping oil, sending it right down to Corey. But Corey's like, dude, you've got to slow down. We don't have any more storage here. We're at our max. In fact, even the tankers that have been hired that are just floating out in the water off the shores of Houston, they're full as well. We've rented all of them. We've got no place to put the oil. But Sean doesn't have a choice. He's got to keep pumping. So what happens is futures Frank is holding a contract for 1,000 barrels of oil. He's bullish on the price of oil because it's so cheap because what's happening with the fundamental situation. But he knows that in the future, oil will most likely be a higher price. The problem is he's got a futures contract that expires. So he has to continually roll the contract over. If he doesn't roll it over, then Cushing Corey has to deliver the oil to futures Frank, but he's got no place to put it. So he calls his buddies who own oil tankers and says, guys, hook me up. And they say, we can't, Frank. We've got no place to store your oil. So futures Frank really starts to freak out. He says, oh my gosh, what am I going to do? I can't take delivery of these 1,000 barrels of oil from Cushing Corey. The only thing I have to do is sell them at any price. Well, what if there's no buyers? No one wants to buy Frank's oil because they don't have anywhere to store it either. So there's absolutely no bid. What ends up happening is Frank has to pay somebody to take delivery of his oil. That's when oil prices go negative. And I think the guys at Real Vision had a fantastic way to describe this. It's something we can all relate to. Say that you're moving on a Monday. So you have a yard sale on Sunday. You've got to get rid of everything. So Sunday morning, you go out there, birds are chirping, you've got your coffee, you're ready to sell everything you have. You've got this awesome looking leather couch, you mark it all the way down to $300. You know that it's going to sell quick. The day goes on, you have people come and go, they buy everything except your couch. So now it's 6 o'clock, the sun's going down, you know you have to get rid of that couch because you're moving first thing Monday morning. What do you do if there's no buyers? Finally, you end up paying 1-800-JUNK to come in their big truck and take your couch away. Exact same thing happened with the oil market. Step number 2, we've built an economy that is so financialized, it's much more receptive to collapse. And there's no better example of that than the oil ETF USO. And if you've ever thought about buying USO, let me save you the time. And I'll say, oh, heck no. Don't buy USO. Heck no. Got to keep it family friendly here. I know there's actually a lot of kids that watch these videos, believe it or not. So, oh, heck no. Don't buy USO. But it's a perfect example of our system being incredibly fragile because of the financialization. So, first and foremost, ETFs have a lot of problems because they provide liquidity, but the underlying asset may be very illiquid. Michael Burry talked about this a lot a few months ago. I did a video on it. We'll put a link in the description below. But when you're buying the USO, you're not buying oil. In fact, they're not buying oil. They're not buying the physical. It's not like a gold ETF where supposedly they're buying the physical gold. That's a whole other video. But they're only tracking the price of oil through the futures market, not by buying barrels and putting them in their garage or in a big warehouse somewhere. And what this can lead to, among many other things, is a negative carry. To understand how this works, let's go right to Investopedia. Negative roll yield occurs when a market is in contango, the opposite of backwardation. When a market is in contango, the future price of the asset is above the expected future spot price, meaning what you can buy it for. When a market is in contango, an investor will lose money when rolling contracts. If an investor wants to roll 100 contracts to a later expiration date, as their current contract is nearing expiration, the investor will be paying more money for the oil contracts compared to the actual spot price. So to understand this, let's look at a chart of the oil term structure when it's in super contango. And I borrowed this from my good buddies over at Macro Voices, Patrick and Eric. Make sure you check out their podcast if you're not already listening. It is absolute gold. So this super contango chart goes from 25, and this is the actual price, up to $52.5. These are the futures contracts that USO would be purchasing. When the term structure is in contango, that means the spot price, what you can buy today, that futures contract that expires this month, is less expensive than contracts in the future. Several different reasons. Number one, the market sees oil being a lot higher in the future than it is right now. There's also storage costs. But it really goes back to the fundamental and technical issues we have right now. Keep in mind, this chart is from about a week and a half ago, so it doesn't indicate the price of oil going negative at the beginning of this week. But you still get the idea. So because we had the fundamental and structural issues we discussed in step number one, the spot price was much lower than even the next month's future price. So let's say, for the sake of this example, the spot price of oil stays at $30 a barrel for the majority of this term structure. You see the price month over month going up and up and up. And this isn't exactly how it works in practice, but this gives you a good idea of the general basics so you can understand why USO continually loses money, why there's a negative carry when you have a contango term structure. So going back to the chart, the price of oil stays at $30 a barrel as time goes on. But the problem, because we're in super contango, USO, or anyone buying futures, has to continually buy the futures contract of the next month when they roll over. If they don't want to take delivery of the oil, they've got to continually pay a higher price than the spot price today. So let's think this through. If you buy futures contracts at $32.50 and the price stays at $30, when you have to sell the contract before it expires, you're going to take a loss, a $2.50 loss. And let's say you want to buy the same amount of futures contracts. Well, you buy those at $35 per contract, but then the price of oil stays the same, so you're selling at $30, taking a $5 hit. You can see how this wouldn't work. The longer you stay in the game, the more money you lose. That's why, especially when we have a contango term structure with oil, USO is an epic fail. You don't want to just walk away from USO. You definitely want to run. And we can see that if we pull up a long-term chart. Editor, let's go to a chart from Yahoo Finance. You can see how the negative carry just gradually eats away at the price. And look at this. If you would have bought USO thinking you're buying oil as just a long-term hold back in 2006, my goodness, you're buying it, say, $80 a share. And now those shares are worth $2.71. Definitely does not track the price of oil. This illustrates the point perfectly on why financializing an economy makes it much more prone to collapse. But, unfortunately, this is just the tip of the iceberg. Step number 3, the shell game. And this is where we start to connect the dots. In my mind, the way the economy is currently set up is it's this inverted pyramid that's incredibly unstable. At the bottom, we have assets. Those are the hard assets like oil, gold, and housing. You could even maybe throw in Bitcoin. But a lot of these assets are purchased with debt. So before we even have the asset, we have to have a ton of debt. But then once we have the asset, then we build this entire paper derivatives market on top of that levered asset. It's like fractional reserve banking on steroids. At the bottom of the inverted pyramid, you have assets which are bought with debt. On top of the assets, you have futures contracts. Then on top of those, you have derivatives like mortgage-backed sausages, CDOs, CLOs. And of course, why not take more side bets on those derivatives through credit default swaps? And then while you're at it, why not buy the credit default swaps, the mortgage-backed sausages, CDOs, futures, CLOs, with even more debt? This is what I'm talking about. And this is why I get so animated when I talk about the fact the financial economy has grown into this behemoth, this blob. It's like Jabba the Hutt that's just completely consuming the actual real economy. It's like a parasite that's taking over its host. And if you think I'm exaggerating, let's go right to this graphic that I always love to reference from the visual capitalist. So we start with a visual representation of how much gold is in the world. 7.7 trillion, 187,000 tons roughly. We go down, we see how much real estate, hard asset, is in the entire world, $217 trillion. And you look at the real estate compared to the amount of gold, you're like, wow, that's a lot of real estate. Oh, but wait, there is more. Just wait till we get to the derivatives. Holy cow. So now the low end estimate of the derivatives, let's keep scrolling down here, is $544 trillion. And I'm scrolling. I'm continuing to scroll. We keep scrolling. And finally, we've got to the 544 trillion mark. But a lot of experts say that it's a lot higher. They peg it at $1.2 quadrillion in size. So to see that, we got to keep on scrolling. My finger's actually starting to hurt. It even says keep scrolling. Finally, we get to the bottom. And I think it's kind of cool that right at the bottom, it shows you a visual representation of Bitcoin. Just one little teeny block. Unbelievable. So it's obvious why whenever we see a crack in the system, Jerome Powell comes running to the rescue. He's right here in the upper right-hand corner. Looks like he's giving a high five to your friend and family member, Fred, who of course is holding a bunch of stock in none other than USO. Totally ignoring what we said in step number 2. Leave it to your friend and family member, Fred. That's right. But he loves the Fed and Jerome Powell. So he says, Powell, keep on printing money. You know exactly what you're doing. So Jerome says, you got it, Fred. I'll keep on printing all of this funny money to prop up the financial economy. This distorts and destroys the real economy several different ways, least of which is a complete misallocation of resources. And that's what I really worry about long term. This entire funny money derivatives system is built on the real economy, which is just stuff, goods and services, oil, gold, housing, Bitcoin, and people producing things that other people want to consume. This is what we need to focus on. So when we start to really dive deep into the question of answering, is the system collapsing? Well, we have to look at the price of oil, what it's doing now. Why? Because it's the only asset that the Fed isn't able to prop up. And if we look at the only asset the Fed isn't able to prop up, and that asset is going to negative $40, what does that tell us about the entire system? To understand the paper side of this even better, let's go straight to my full-length interview with Luke Groman.
The way to think about a stock-to-flow ratio is basically how many shells are in a shell game, right? So stock-to-flow ratio of 1 to 2 means there's 1 to 2 shells in the shell game. So you don't have to turn too many shells over till you find the P. And the P is supply-demand, physical supply-demand fundamentals. And so the punchline is you can't get supply-demand fundamentals that far away from oil in the future, sort of almost no matter how much paper you throw on it. And I don't track how big the futures have gotten in Bitcoin, but just understanding how this paper tail can wag the dog. We've seen it with oil now in spades. Just discussed how it can help, or it can distort underlying supply-demand fundamentals in gold for periods of time. We saw it when futures rolled out at the end of 17 on Bitcoin. It obviously, I think it contributed to some of the drop in Bitcoin prices in 2018. So to me, I'm always cognizant that when you have this derivative market attached to it, you're not dealing, to the stock-to-flow ratio model. Stock-to-flow ratio on Bitcoin might be even higher than gold. And so that means the ability to separate, if you have a mature or a more mature futures market, the ability to separate the supply-demand fundamentals from price is greater, the greater the stock-to-flow ratio is.
So are negative oil prices indicating the entire system is collapsing? I would answer that question by saying negative oil prices are just showing us that if the Fed wasn't propping up the entire system with all the funny money, it already would have collapsed. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here. I will see you on the next video.